The largest financial position on Earth is not held by a hedge fund or a global bank. The United States government, by carrying the heaviest debt burden in human history, is the largest entity short the US dollar. This chart tracks US debt to GDP levels over the long term. Note the point where the trajectory shifts from a manageable incline to a structural verticality, breaching thresholds that have historically defined fiscal sustainability. This acceleration intensified after the Great Financial Crisis. As demographics shifted and growth slowed, the global system systematically pushed private sector leverage directly onto the sovereign balance sheet. This transfer of leverage turned the state into the dominant macro actor. In the modern economy, the federal ledger dictates the rhythm of the cycle more than corporate output or consumer sentiment. Traditional macro analysis often fails here because it attempts to model the economy using private sector variables while ignoring the inescapable mathematical gravity of the sovereign debt burden. Focus often lands on the headline debt figure, but the real systemic pressure is generated by the cost of servicing it. In a fiat system, as debt scales, the interest expense becomes the primary driver of policy. This breakdown illustrates the cannibalization effect. Rising debt servicing costs consume an increasing share of federal spending, physically displacing the capital that would otherwise flow into the real economy. When interest expense breaches the boundaries of organic tax revenue, it creates a structural funding gap that cannot be closed through traditional belt-tightening or tax hikes. Policymakers eventually face a binary trap. The state cannot explicitly default, yet it cannot organically outgrow a debt burden of this magnitude. This mathematical reality acts as the true catalyst for regime shifts, forcing the system to move from a state of natural growth to a state of survival. When organic funding fails, the state's preservation mechanisms activate, shifting the economy toward mandatory, forced monetary intervention. To understand how this intervention reaches the market, we must look at the foundational macro identity. The public sector deficit mathematically equals the private sector surplus. Consider this flow. Every dollar the government borrows and spends must enter the private sector's accounts. When sovereign interest burdens become unmanageable, they force the public deficit to expand, sending a flood of liquid capital into the private sector reservoir. Because the US dollar is the global reserve currency, this forced deficit doesn't just flood domestic accounts. It dictates global systemic liquidity for every participant in the financial system. There is a vital distinction here. This isn't productive spending on infrastructure. It is the purely mechanical, forced distribution of interest payments into the financial system. This dynamic creates financial repression. To alleviate the real burden of the debt, the state must liquefy the system, effectively diluting the debt through the creation of new currency. Extreme sovereign interest expense serves as a mechanical engine, pumping liquidity into the private sector as a mandatory requirement for state survival. Managing this burden requires specific tools: debt monetization, monetary accommodation, and engineered liquidity creation. The paper debt is transformed into liquid market support. A common misconception among professionals is that central bank rate decisions are the primary source of liquidity cycles. In reality, the fiscal interest burden often forces the central bank's hand long before any official change in policy rates occurs. The math of the Treasury dictates the actions of the Fed. We must track where this liquidity goes. In a highly financialized global economy, this newly created capital does not primarily fund real-world industry or labor. It seeks out financial assets. This excess capital flows into equity markets and credit spreads, fueling speculative risk-taking and driving asset prices higher, regardless of the underlying economic health. This explains why risk-on market regimes often ignite, while real-world economic data still looks recessionary. The liquidity arrives before the growth. The central bank is the valve, but the sovereign interest burden is the engine. It provides the underlying pressure that dictates the performance of risk assets. The logic macro regime system maps this process. It starts at the first node, rising U.S. interest costs. These costs trigger the second node, liquidity creation. The state must generate funds to cover servicing obligations. This liquidity moves downstream, expanding the availability of capital at the third node, financial conditions. Easier conditions eventually stimulate the fourth node, growth. though this often manifests as asset price inflation first. Eventually, excess liquidity leaks into prices, hitting the fifth node, inflation. Institutional money anticipates these shifts, leading to the sixth node, capital positioning. The chain concludes at market regimes, representing the definitive shift investors experience. Each node in this chain behaves predictably once the pressure at the starting point, sovereign interest, is accurately measured. Most macro analysis fails because it begins at growth or inflation, missing the initial fiscal trigger that put the entire cycle in motion. Understanding this transmission mechanism provides a structural advantage in capital allocation that standard economic models simply cannot offer. U.S. government interest payments serve as a primary indicator for future liquidity conditions, providing insight into policy shifts long before they are officially announced. There is a lead time advantage. Here, the interest expense spike on the far left marks when fiscal math becomes untenable. The resulting market regime shift occurs much later. This wide gap creates a predictive window, offering a forward-looking view into the next liquidity cycle. This specific metric provides the core predictive engine for the logic macro regime system, allowing us to identify turning points before they are visible in coincident data. The broader industry overlooks this, distracted by political headlines or lagging indicators that describe where the economy was rather than where the liquidity is going. Macroeconomic foresight is found in the inescapable mathematical constraints of the sovereign, not in the noise of the daily news cycle. This explains why markets frequently begin massive rallies well before the economic data shows any signs of improvement. The market is responding to the liquidity engine, not the GDP report. Weighing for lagging indicators like employment or CPI to signal a market entry is a recipe for missing the move. By the time the data looks good, the liquidity-driven rally is often near its peak. The logic is clear. Rising sovereign interest costs mathematically dictate future systemic liquidity creation. Liquidity remains the fundamental, overriding fuel for all asset markets. In a highly indebted world, it is the only variable that truly matters for long-term returns. The logic macro regime framework integrates these early sovereign signals to proactively map capital positioning for the regimes ahead. Investors who ignore the sovereign liquidity cycle risk being blindsided by major turning points, as they are looking at the symptoms of the economy rather than the source of the capital. Mastering the mechanics of the sovereign short provides the specific roadmap required to navigate and predict the next market regime.